Hi, my name is Shreyans, and today we are going to do a basic financial analysis of the first PSU company in this series. I think most of us use its products or services almost on a daily basis. It is that big, it is that central to our lives. So let's get started. But before that, please remember this is not investment advice. We just want to understand the financial performance and financial position of the company. All right, the company that I'm talking about is BPCL or Bharat Petroleum Corporation Limited. It's an oil and gas PSU conglomerate, as you might know. The most common products that we probably use on a daily basis are petrol and also the LPG cylinder. So you might want to go back and check if the LPG cylinder at your home is actually from BPCL. Apart from these two, it also does a host of other things in the oil and gas space. For example, it operates refineries, it also provides fuel to the aviation sector and also different raw materials or fuels to the different industries as well. So it has a wide range of different businesses in the oil and gas space. Now, first we'll start with the financials and then we'll wrap up with the highlights. So if you look at the financials here, starting with revenue, the thing that you would notice here is that the growth in revenue overall has not been that great, right? It is almost just probably little less than 2x in these years. But what you'd notice is it has been slightly inconsistent. So if you look at the revenue growth here, so 1, 2, and these 3 years, it has actually double-digit growth. And in fact, in 2 years, it's extremely good. Here, 17.2. In fact, in 4 years, actually, here it is also 26%, 38%. That's also pretty good, right? But then there are 3 years in which it has gone down. So this year, and also this year here as well. And in 2 years, it has had high single-digit growth. So revenue has been slightly inconsistent, so to speak. Now, if we talk about EBIT and PAT, the broad trend in EBIT and PAT, if we accept this year here, apart from that, the broad trend in EBIT and PAT has been pretty solid. It has been growing steadily. It actually grew very well in this year here. And then again, 3 years were sort of in consolidation period, but then here it felt slightly. And in this year, it has felt extremely, it has fell a lot, right? So it has basically from 11,500 to just 4,000 crores, it's almost like 35% only. And here from 6,800 crores to only 1,655 crores. So that is almost less than 25% even, right? So I tried to check the reason for that. I thought there might be some, some abnormal item or some exceptional item, so to speak, but that was not the case. Because if you could also look at EBIT here, the reason EBIT fell so much was because of the increase in the major raw material cost, which I would suppose is crude oil, right? So there actually is a double whammy here, right? Because the revenue also fell by almost 14,000 crores, and then the major cost, which represents about 85 to 90% of its costs, that also increased. So even a 2 or 3 percentage point increase there led to this decline, that's sharp decline in EBIT and PAT, right? If you look at the cash flow from operations, very strong cash flow from operations. If you look at the cumulative CFO here is 91, almost slightly above 91,000 crores, and it is almost, in fact, it is more than twice of that of PAT, right? And it has been consistently greater than PAT in all the years, right? So I mean, the cash here is strong, right? If you look at the cash flow from investing, you'll see that the company has continuously been making investments into its business, and I think that's quite necessary for the company as well, right? Because of the sheer scale that it operates. If you look at the cash flow from financing here, there have been mostly outflows, but then again, we should not be misled at the surface level, because if you look at these figures are relatively low. And if you also look at the broad cash flow position, then you might think that, okay, the company is also reinvesting and it is also paying out dividends, right? But then the real picture with cash flow from financing is that there have been a lot of transactions related to borrowings as well. So the company has paid a lot of interest, company has repaid its borrowings, it has raised new borrowings as well. So that is why net and net the figure seems optically lower. And if you could look that, it seems that no operations are enough to fill for investing activities and financing activities, but that might not really be the case. The company has continuously paid dividends in all the years, and I think that is something you might expect, because the government also, uses this company as a source of funds, right? So this is something that you need to be, if you look at the company, you need to be careful about understanding the cash flow from financing, right? The equity has increased by almost 2.4x. If you look at the broad trend here, it was the highest year in FY19, and then probably because of lower profits, and that is lower profits, and then probably some uh, maybe some payout or something like that, due to which the equity might have decreased here, right? The current assets have broadly, I mean, if you look at the overall trend, it is not much. If you look from 35,000 to 43,000, but here they rose up to as much as 46,000, then they fell, and they also rose up to 48,000, and now they fell to 43,000, right? So it seems that broadly they're operating in some sort of range. The non-current assets have obviously increased, right? There've been massive reinvestments into the fixed assets of the company, right? They've increased by 3.4x from 31,000 to 1,07,000. And if you could see that there seems to be a massive investment here, right? It's almost of 19,500 CR. Apart from that one massive reinvestment, it seems to be here. Otherwise, it's broadly been, increasing bit by bit every year. When it comes to current liabilities started with a very high figure, right? And it has also, you could understand that the trend of current assets and current liabilities and revenue would somewhat, go along, because current assets and current liabilities net up to form the working capital, right? The thing to notice here is that current liabilities is actually greater than current assets in almost all of the years, except for a couple of years maybe, which we'll look at, which I'll show you later. But yeah, so this is one thing to notice. Now, the current liabilities includes trade payables. It can also include short-term borrowings and some other current liability items, right? So I don't know how good of a thing a negative net working capital is, because I mean a lot of that are commitments, short-term commitments, right? Non-current liabilities, if we compare non-current liabilities versus equity, whereas equity has increased by 2.4x, non-current liabilities have increased by a 5.4x, right? So it's even more than the increase here is even more than double, right? And if you look at the broad trend here, then probably till there's one sharp increase here, another one here, slight fall, somewhat increase, and then from 29 to basically 52 in a short span of just 3 years, right? So it seems that the company has raised borrowings. Most of the non-current liabilities are borrowings as well, right? And so we've more or less we've talked about the growth as well while we were discussing the different financial positions. Inconsistent with respect to revenue, with respect to EBIT as well. I mean, slight inconsistency. I mean, there have been years with very high, then very low as well. So I mean, that is something that is probably down to the nature of the industry, because so much of it depends on the price of the crude oil, right? With PAT also, this is something similar that you'll notice here. Some years been very strong growth, because if you look at the range here, then the maximum growth is 140%. The maximum for EBIT is 68%, but the minimum are 65.1 and 75.9%, which is actually in the most recent year as well, right? Cash flow from operations slightly volatile. That's understandable, but it more than sufficiently covers for the PAT, right? Equity slow growth. It's more or less okay. With assets, we've already talked about the continuous investments. Net working capital has, in most cases, been negative, right? And it has been, I mean, the difference we'll see is been growing or declining. It's a different trend, sort of trend, right? Liabilities also have also broadly increased, except for a one small increase here. So if you look at the overall CAGR of liabilities, the 9.3 might look more or less lower than the 10.1, but that is because of the fact that non-current liability started with a already high figure, so from 40,000 to 60,000, so that is only about 1.5x. But non-current liability started from a much lower figure and went to almost equivalent to the current liabilities, right? So that is why this overall liability CAGR seems low, but we must not be misled by this. If you look at the metrics now, let's get with the metrics. So if we start with the ROCE and ROE, the company has had ROCE greater than 15% in a few years here, right? But in the most current year, the ROCE and ROE have suddenly fallen because obviously of the fall in PAT. But there were few years when the company was able to, perform very well, so to speak, at least in terms of the return on capital ratios. But then it obviously fell here because of the fact that the EBIT and PAT suddenly declined. If you look at the margins here, the margins are a very, very big problem, right? Because the margins are abysmally low. You have 1.6% or 1.1% here, and the highest margins that they have ever been are 5.8% here and 4.1% here. So these are extremely low margins, right? And again, these are probably the lowest margins that the company has had, or close to the lowest margins that the company has had in this current year. So it will be interesting to see how it goes forward, especially with the massive fall in the price of crude oil in FY21. So we might see some sort of expansion there, but then again, it is very difficult to factor in the different external pressures that there are on the company. When it comes to capital turnover and asset turnover, the asset utilization of the company is actually very strong, right? In fact, at least in these 5 years here, it's been very strong. But in these 5 years, right? So the most recent 5 years, it's been more or less operating around the range, and it has been lower than the median, right? So the median capital turnover here is 4.53, and the median asset turnover is 2.24. But in the recent 5 years, it's been lower than that. So that is also something that needs to be looked at. With assets by equity, so this is the measure of financial leverage. It has never fallen below 1. So this is something that you can understand. So currently it stands at around 4.13. So for every 4.13 rupees worth of assets, only one is financed from equity. The rest 3.13 is actually financed by liabilities, whether short-term or long-term liabilities. And as we saw, both the short-term and long-term liabilities are quite significant, right? CFO to PAT, this is something we've already talked about. Very solid numbers. It has always been greater than the profit, and I think that is because the company would have massive depreciation charges because of the massive asset base, and then it would also have some interest payments that would subsequently be reclassified to the financing activities. With net cash flow here, it is an increase and decrease, but this is something that's better if we look at the specific components of the net cash flow, especially with financing and investing activities, because that would give us a better picture rather than just looking at these numbers, right? These summary numbers are helpful a bit, but then it is also important that we go deep down to understand. With net working capital, as we talked about, it's mostly been negative. There've been 1 year here and 1 year here when it has turned positive, but broadly the trend has been that there've been a lot of current liabilities and not enough current assets, right? So we think that if a company is working on on a negative net working capital, it's a very good thing, and this is something that you'll probably find, that negative net working capital or very low net working capital in FMCG companies. But I'm not sure how good of a thing this is for a company like BPCL. With non-current liabilities to equity, so earlier you could see that it was equivalent or less than that. Then here, these years as well, it was more or less, it was around the equity here only, but in this year it is at its maximum. So this is 1.42. So this is non-current liabilities have actually surpassed equity, and we also saw that the equity here has increased by only 2.4x, whereas the non-current liabilities have increased by 5.4x, right? So that is it about the different metrics that we have. And now let's quickly summarize about the company. So mixed revenue growth, this is something that we saw. Now EBIT and PAT reached a maximum of 5.1x and 4.7x, but fell sharply in FY20, right? So if you look at the maximum EBIT, then the maximum EBIT is here, which is about 12,250 CR versus 2397 CR in FY11. So this is a good growth, right? And similarly, if you look at PAT, the PAT was maximum here, which is about 7,700 or 800 crores versus a 1,630 CR PAT here. So it was going well, but then it suddenly fell apart in FY20 because of the high material costs. Solid cash conversion, we've already talked about it. Cumulative CFO is even greater than 2x of the cumulative PAT, right? So that is something that you could also see, that how much the non-cash charges are driving down the profitability of the company. At surface, CFO looks sufficient to cover CFI and CFF. So this is something, if you look here, the net figure is only a negative of 1300 CR here, right? But it might not be the best way to evaluate the cash flow position, at least with respect to this company. So CFF contains regular borrowing related transactions, which includes interest payments, debt repayments, and new debt issues as well. Equities increased by only 2.4x, but non-current liabilities, the primarily which are borrowings, have increased by 5.4x, right? So it seems that the company is constantly raising external capital, right? The current liabilities are greater than current assets in 8 of the last 10 years, which is we've already seen. Return on capital greater than 15% in 5 out of the last 10 years, and return on equity greater than 15% in 6 out of the last 10 years. In fact, if you look at the return on equity, it is actually greater than even 20% in a lot of years. So 1 year, 2, 3, 4, 5. So 5 out of the 6 years, it's actually greater than even 20%. And that is somewhat an impact of financial leverage that you can see. EBIT and PAT margins are extremely thin, right? Wafer thin PAT margins, and the max in last 10 years, the max for EBIT is 5.8 and max for PAT is 4.1. So these are very low margins. Now you could argue that a lot of this has to do with non-cash charges, but still, I mean, most of the costs are really the material costs, right? Capital turnover, solid. Asset turnover, solid. Capital turnover greater than 3x in all of last 10 years. Asset turnover greater than 2x in 7 out of the last 10 years. For a company of such a huge size, to maintain such turnover ratios are pretty good, and also the kind of industry that it is in. But both are below the median in the last 5 years, right? And they have seemed to stabilize a bit. So let's see how it goes ahead. Financial leverage has never been below 3x. Financial leverage is basically the assets upon liability, assets upon equity, which we talked about. Currently, non-current liabilities stand at 1.4x of equity, and there are significant current liabilities as well. So what's the conclusion with respect to this company? My understanding of this company is the fact that it has effective asset utilization, right? I mean, at least it seems so, but abysmal margins, very, very low margins, right? Because of the nature and inconsistent revenue growth, right? So even with EBIT and PAT, there has been some upward consistency if we just omit FY20, but with revenue, it has been a mixed bag, right? It has increased and it has decreased. So that is not the best thing. And then the company also has multiple external pressures, right? So there is government ownership. So obviously, when there is government ownership, it might not be the best for the company, so to speak, right? But obviously, the government has to take care of the public interest at large, and often the PSU companies have to bear the brunt of that, right? And then obviously, with the oil prices, it is such a complicated game across the whole world that how the prices change, how much of the oil is sourced from inside India, how much from outside India, and then there are multiple external pressures operating globally that affect the price of oil. So that is something that, it seems that is outside of the control of the company, right? So that is my understanding of the company. That is all that I had to share about the company. If you found this helpful, then please let me know. Please comment below. If you want to discuss further about this company, then you can drop in a comment or you can reach out to me. If you want to look at the workbook, or if you want to sign up for more of this investment analysis, you can find the links to both of them in the description. That is all that I had to share. I think this. I did not know a lot about BPCL before this, so understanding its financials, it's kind of a mixed bag. But I hope you found this helpful, and you can decide whether you want to research this company further or not. If you found this helpful, please do share this video, and I'll see you again with another company.